policymakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine this morning. As we said, let's get back to our top story. The U.S. and European Union have struck a trade deal imposing a 15% tariff on most EU exports. That includes cars and pharmaceuticals. As part of the pact, the bloc will ramp up purchases of American energy and boost investment within the United States. It all sidesteps Donald Trump's threat of steeper levies.
So I just want to congratulate you. I think it's great that we made a deal today instead of playing games and maybe not making a deal at all. I think it's, I'm going to let you say, but I think it's the biggest deal ever made.
We have a deal. We have a trade deal between the two largest economies in the world. And it's a big deal. It's a huge deal. It will bring stability. It will bring predictability. That's very important for our businesses on both sides of the Atlantic. It's 15% tariffs across the board, all inclusive.
We've got all the angles covered this morning with our anchors and correspondents around the world. First in Turnberry and then, of course, in Stockholm as well. I want to start off with Scotland because, of course, that's where the deal between Ursula von der Leyen and Donald Trump happened. Our very own Lizzie Burden is on location. Lizzie, walk us through the last 24 hours.
Well, Ursula von der Leyen, the European Commission president, came to Turnberry herself. This is, of course, one of Donald Trump's golf resorts here in Scotland, and she sealed the deal right here, this 15% US tariff on most EU goods. And it's all inclusive, so Donald Trump can't come back and slap extra levies on chips or drugs or cars for that matter. But look, there are lots of EU member states who are annoyed about this, lobby groups who are annoyed about this, because, of course, the US is paying far less than the other way round. Von der Leyen herself acknowledged that that's because she needs to redress this imbalance in US-EU trade. The relief is, and our economists have calculated this, is that before this deal, the EU would have faced an 18% average effective tariff rate from the US. Now they're going to face 16% because that no-deal scenario has been averted. Of course, the deadline was fast approaching on Friday, August 1st. But how did she seal this deal? Well, von der Leyen made a sweetener package promise, just as the Japanese found that they had to do. She offered $750 billion worth of investment spending on American energy products, $600 billion when it comes to investing in the US economy on top of existing pledges, and she's promised to spend vast amounts on American military equipment. So it's this broad package that you're seeing driving European equities higher. But as you say, euro dollar not so impressed, perhaps because a lot of this was already priced in.
Lizzie Burden live in Turnberry on the ground for us, covering the latest from Donald Trump's visit there. Of course, Keir Starmer very much in focus in terms of the next few hours. But let's get into Stockholm, where conversations between the United States and China are taking place. As promised, we're covered there, too. Bloomberg's Oliver Crook on the ground in Stockholm. Ollie, just walk us through what gets us across the finish line here. Are we going to get a deal? Are we going to get an olive branch? What do we expect from today's talks?
We're expecting this to be a really sort of large kicking the can down the road event, because remember, the situation between the United States and China in terms of the tariff reciprocity right now is they've brought it down from that 125% tariffs that they escalated to on the early stages of the Trump administration. Now there's only a 30% tariff between the United States and China, but that expires on August the 12th unless there is a way to extend that truce for a longer period of time. And that is what we expect here today from the Treasury Secretary Scott Bessent and the Chinese Vice Premier, who will be meeting just behind me in the next couple of hours at the Swedish Prime Minister's office, where usually the cabinet and the Prime Minister reside, really sort of vacating that, or at least giving some space up to the Chinese and the U.S. to negotiate. So what the main objective here is going to be is to get another extension, likely 90 days, in order to continue to hammer out their fundamental trade disagreements, which, of course, for Donald Trump has been one of the sort of premier points that he has made in his election campaign. He's going to fix the trading relationship with China. That will involve conversations about, getting, for example, U.S. agriculture into China. It is involving already very challenging discussions around rare earth metals, around the AI chips that the Trump administration has now granted access to NVIDIA to sell into China. So these are going to be many of the conversations that will lay ultimately the groundwork for what we saw yesterday from the EU with China, which is a full comprehensive trade agreement between the United States and China. We're still some distance away from that. We understand that President Trump and Xi Jinping have spoken on the phone. Xi Jinping has invited Donald Trump to China with the First Lady in order to potentially, have those closer interpersonal meetings, person to person. And I imagine that longer term, when we ever get a trade deal between the United States and China, that will likely be an event that will be held in person. But right here is the important plumbing, the groundwork laying that will be done by the Treasury Secretary of the United States and the Vice Premier of China.
Ollie, can you just walk us through some of the sticking points here? In our last hour program, you mentioned things like buying exports. You mentioned things like technology, the TikTok deal as well. How much progress do we get on that? Or is this simply a question of buying time?
No, I think that you will make material progress in some of these sectors. I don't know how openly it will be negotiated out in the open, but as you point to, Kriti, there's a ton of different open questions. There is a question of AI chips. That is kind of one of the main principal objectives for the Chinese, is to continue those flowing into China, and for the United States, getting those rare earth magnets into the United States. But we should say there have been concessions in the last couple of weeks on that, Kriti, and we have had a sort of more positive and I would say a softer tone from the Trump administration, but they have not given these as olive branches for free. These are both sectors in which China is dependent on the United States and the United States is dependent on China. They are dealing on these issues because they have to. There are other issues like TikTok, for example, as you mentioned there, Kriti. Trump has said that there is a U.S. buyer ready to go to buy TikTok. That still needs sign off over from the Chinese. So that will certainly be another conversation. And of course, this question of fossil fuels, crude oil, where China is getting it from. They're still buying from Iran. They're still buying from Russia. That is technically sanctioned oil and fossil fuels. The U.S. would like to see a diminishing of that. So these are going to all be part of the sort of mosaic of different issues that will be arising between these two men, and potentially, again, setting that groundwork for a comprehensive trade deal between the two largest economies in the world.
All right, Bloomberg's Oliver Crook, of course, in Stockholm, walking us through those conversations between the U.S. and China that we are expecting to have. Let's bring in Kallum Pickering, chief economist over at Peel Hunt, about just how this economy, global economy, is digesting these trade deals. Callum, we've had a lot of news in the last 24, 72 hours. I want to do a wellness check on you, but first, talk to us about these numbers. 15% from the EU is higher than, I think, what a lot of the markets were expecting. Not by much, but slightly. Japan, 15% was higher than expected. To what extent was that a framework for perhaps some of the discussions that are happening in Stockholm today between the world's two largest economies? I think that's probably going to be the baseline. It's hard to imagine the US wants to give allies, Japan, the EU, UK, a worse deal than is offered for China, given that that's the main geopolitical and economic rival for the US. These are much harder trade negotiations that are ongoing. But let me give you a different stat. 3% of global GDP. That's the US import number as a percent of global GDP. The uncertainty has always been worse than the disease, and the two big risks at the start of all of this in April. First, that the US would go into recession. That's now much reduced as a risk. And second, that the whole world could escalate into a tit-for-tat trade war. That's been taken off the table. And so what we now see in markets is a great deal more certainty, and with that a focus on some of the other drivers of global trade and production, central banks cutting rates, the big fiscal stimuluses we have around the world, the fact that actually we just need to buy some stuff eventually, and we've not had a proper trade cycle since before COVID. When we're talking about that COVID conversation, though, there's an argument here that because so many of the supply chains are almost supported and have gone through this exercise, they've been stress tested, that an increase or even a change in the tariff rate would not be as painful as perhaps if we were having this conversation during the first Trump administration. How flexible, how tested is this economy? I think that's right. We've consistently been hit by huge shocks repeatedly, and what we've realized time and again is our worst fears have never been realized, the mountains are still standing, and actually private economies are just much more flexible than we had anticipated. But also I think there's just a degree of, is the global economy in a good place when the US is practicing
trade protectionism? No. Is that less bad of a situation than a land war in Europe causing a huge gas shortage, than 30% of the global economy in lockdown overnight, as we saw in 2020, or the 500 basis point increase in interest rates that we had in 2022 and 2023? Yes, it's less bad. And in that world, actually, it starts to look like an improvement. But I would just emphasize, with this COVID example, just the wisdom of markets, where the individual investor, economists like myself, say, well, there's a great deal of uncertainty, but markets are providing us a very strong signal that the world economy is heading for an unspectacular, but still an expansion in global trade and global production. This, for me, is like it was in the late side of 2020, when we were heading into a winter lockdown. Everyone was fearful. You remember we had the K-shaped recession warning, the L-shaped. We were murdering the alphabet. The market went to an all-time high. That was the signal for the V-shaped recovery in 2021. So I'm paying attention today to the wisdom of markets, and it's a healthy signal for the future.
What about all the fiscal spend? I mean, I'm waiting for, we were having this conversation in the last couple of hours, I'm waiting for the deficits to become a conversation again, for this equity market, for this bond market. And it kind of feels like it's been widening deficits on both sides of the Atlantic has been excused by the idea that you are getting fiscal spend, whether it's from the one big beautiful bill or whether it's from Germany or wherever. Is fiscal spend the solution to keeping these economies chugging along?
I actually would personally prefer to see mass deregulation across the advanced world, just open up markets, labour markets, land, energy, production, so we've got more economy to tax. That would solve the fiscal problem, in my view. This fiscal problem is a serious one. No one across the spectrum, political spectrum, across any major economy, is seriously having a serious conversation about how you deal with the welfare and the pension and the ageing population problem. At some point, this is all going to blow up. I don't think it's going to be a kind of financial crisis scenario. What will probably happen is markets will penalise countries for behaving badly on fiscal. They'll sort their tax and spend out, and after a few months, it will be resolved. And what you'll find is once you've got fiscal predictability, private markets will then just resume normal economic activity. So I think for now, actually, it's just good for markets that we've got some fiscal stimulus, the trade risks are coming down, and forget about all the noise, a bit more inflation. But Bank of England, Fed, probably the ECB can keep cutting rates. Global economy muddles through with growth. It's a buy risk, it's a buy equity story, and that's what the market, I think, is telling you.
What about the tariff impact, though? We keep hearing these warnings. We heard it from Christine Lagarde. We've heard it from Jay Powell. I'm sure we'll hear it from Governor U.A. this week as well, that the tariff impact is going to come in a inflationary, hawkish way. But if you look at the data, it hasn't shown up yet. What do we hear from the central banks this week that addresses that concern?
So let's start with the Fed. The Fed has been more preoccupied with the uncertainty of how much inflation you will get from tariffs than the worry that tariffs could provoke a long period of sustained inflation in the US. This was always likely to be a temporary phenomena. The problem with tariffs is they basically set the two targets that the Fed has, employment and inflation, on a collision course. Because on the one hand, tariffs are anti-growth. No question. The US economy is moderating into this year versus where it was into the last couple of years, which depresses employment activity, but also temporarily puts up inflation. So there's all this idea that the Fed would just have to wait to see how much inflation you get. And even if the labor market is deteriorating, just wait for inflation to have a two-handle before cutting. We've got, with the EU deal, with the Japan deal, the UK deal, let's see, Canada, Mexico, I think we'll probably get a deal before the 1st of August. That's 2/3 of US imports. The Fed at this point will have a pretty good idea, just assuming that baseline tariff that you mentioned, 15%, where inflation is going to go and where it's going to land, which means probably the Fed in this meeting might have a bit of courage to signal to markets that we'll get a couple of cuts into the second half of the year.
How much of the FX story is twisting the knife in this tariff story, whether it's strength for the European exporters or whether it's weakness for American buyers?
I'm so glad you brought this up. So on the euro move today, which seems to be a bit of a puzzle versus the equities move, so European equities up, but the euro down versus the dollar, that move, in my view, makes sense. If I'm a European exporter to the global economy and I've removed the tail risk of an escalating US tit-for-tat trade war, I would expect my stock price to rise. But given that European exports in the US are going to be more expensive, demand for those exports will decline, which means I'm going to demand fewer euros in order to buy exports from the Eurozone. So this move makes sense based on economics. The other FX story is the gradual depreciation in the dollar that I think is likely to continue. Why? Because on a risk-adjusted basis, the US market no longer looks so attractive, and that depreciation of the dollar reflects a repositioning of global money managers a little bit away from the US towards Europe and other parts of the world. It's not sell US, buy Europe. It's just as the world economy grows and we have more income to invest, the allocations are starting to shift. We're no longer overweight US, we're neutral. We're no longer underweight Europe, we're neutral. And that shifts currencies because of these marginal flows.
Is that a tactical shift or is that sustainable?
That's probably a sustainable shift. We see these long periods where the US is the only game in town and the dollar moves up and US markets become expensive. Then there's a structural change and then the story breaks. We had a best part of a 6-7 year depreciation in the dollar from the mid-80s until the early 90s. We then had another one from 2001 to 2008. On those occasions, the DXY, which is on the Bloomberg terminal, we had a 52% depreciation the first time, about a 45% depreciation the second time, which means we might only be a third way through this dollar story and say the first year of a 4 or 5 year trend.
All right. Kallum Pickering, Chief Economist over at Peel Hunt, walking us through those dynamics between Europe, between the United States. We didn't even get to China yet, but we will get into a little bit more of those details coming up on the program. We're also going to be talking about the sector-specific impacts. Several manufacturers reporting this week. We're going to talk about how the European auto industry stands to benefit from the EU-U.S. tariff agreement. 15%, that's the level. Is that too high or too low for this sector? Stick with us. We're going to dive into it next. This is Bloomberg. Now, the top story of this morning, 15% when it comes to the EU's trade deal with the United States. Turns out it's also for pharmaceutical exports, the largest sector that actually exports from Europe to the United States. It's pharma. There were a lot of fears that they would be subject to a much higher tariff, but it's 15% for now. Richard Bravo, our European government editor, is all over this story, joins us this morning from Brussels. Richard, Donald Trump has said this before. He said that there would be some sort of tariff on the sector, giving Americans specifically some time to build out their manufacturing capabilities stateside, ultimately hitting some sort of level like 200% was the number he's thrown out previously. For the pharmaceutical sector, is 15% a win?
Well, I mean, in this tariff fight, everything is relative. So the EU and specifically Ireland, where a lot of American companies have located their manufacturing for pharmaceuticals, they have to be very happy that they're getting off with 15%, not something higher like 50% or even 200%. So it is a massive win in that sense that it looks like pharma is included in that 15%. But last night during the press conference of European Commission President Ursula von der Leyen, she did seem to leave open the door that there might be a higher tariff coming on pharmaceuticals. So everyone's still trying to sift through the details of what the agreement actually was. And as you well know, there are very few details that came out from the Trump and von der Leyen meeting last night. So everyone's really looking to see what comes out in the coming days on that.
Well, Richard, the other kind of unresolved issue here, and I thought this one was interesting, is one, the kind of wine and spirit sector. So that's one, but also steel and aluminum tariffs, which Ursula von der Leyen had said would switch to a quota system. What do we do, or how do we interpret the lack of progress in those two areas?
Well, in this area, it seems like it's kind of mimicking the deal that the U.S. reached with the U.K., where they said that they would figure out a quota system whereby the UK would be able to send a certain amount of steel and aluminum into the US without tariffs, but above that quota, then the tariffs would kick in. It seems like I said, there there are no details on what agreement von der Leyen and Trump reached, or even the contours of that agreement. But it seems like von der Leyen is hoping that there will be a quota system in place to at least mitigate those tariffs, which for steel and aluminum are 50%.
Certainly something we're going to be keeping a close eye on. Something that actually happened under the Biden administration, too, as well. I'm curious if we go right back to that system. Bloomberg's Richard Bravo in Brussels joining us for an update on some of the nitty-gritty in that trade deal. Part of that nitty-gritty is how the 15% applies to the auto sector. Porsche and Mercedes stand to gain significantly from that deal with an agreement that lowers the rate on the current tariffs, potentially boosting their earnings by, get this, $1.6 billion. Craig Trudell, our global autos editor, is all over this story. You're seeing a rally in car makers this morning. Is this a sigh of relief?
I think this is going from tariffs that were going to really, really hurt to just really hurt. And so, the way that the market was pricing a lot of these company shares was for significant damage and for sort of more of a worst case scenario. We did see some adjusting last week when the deal with Japan was struck, because it was substantial relief for the Japanese car makers. It doesn't necessarily mean that these tariffs are a win, in the sense that we still have a 6x change in the tariff that manufacturers are going to pay. Like a Porsche, where before they were paying 2.5%, now they're going to be paying 15%. So this will still be damaging to earnings. It just won't be nearly as harmful as it could have been or was poised to be.
So there was a clear line in the press conference between Ursula von der Leyen and Donald Trump where they talked about addressing issues of overcapacity, and that felt like a not-so-veiled reference to China. We know that EVs specifically have been a real pressure point for that question of overcapacity. What does this mean when it comes to China's contribution to the auto industry?
It's interesting because obviously this was something that was a huge bugaboo for Janet Yellen in the previous administration. So it's something maybe that the Biden administrations and Trump administrations, are sort of aligned on. And for good reason, because the amount of capacity that you have in China for car manufacturing is multiples of what that domestic market can handle. So it is a serious issue and one of great concern for European manufacturers in particular, given the fact that tariffs have only applied to EVs and not, sort of cars more broadly.
I'm going to put you on the spot here. Canada and Mexico, we still have to get clarity on those. We're still approaching the August 1st deadline coming up on Friday. Does that change the game, I imagine, for the supply chain, the manufacturing capability?
That's going to have a huge there are huge implications for that for the American manufacturers if the GMs and Fords cannot get some relief for all of the pickups, in particular the big pickups and SUVs that they make in Canada and Mexico. There's real concerns that with these deals that give Japanese and European competitors some relief, that it sort of narrows the competitive, sort of advantage that the Trump administration could otherwise give U.S. companies.
All right, Bloomberg's Craig Trudell walking us through the auto story quite literally around the world. We thank you so much. Coming up, we're going to talk about these trade talks that are happening in Stockholm, what they mean for the conversation with China, and whether or not there's a deal on the horizon or just kicking the can down the road. More next. Stick with us. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Kriti Gupta in London. Let's get to our top stories this morning. European stocks gaining, U.S. futures on the rise after Donald Trump is calling the biggest of all trade deals with the EU, a whopping 15%. But up next, it is Keir Starmer's turn. The UK and U.S. leaders set to meet to remove remaining obstacles to their trade deal and press for a lasting ceasefire when it comes to Gaza. Plus, seeking an extension, Chinese and U.S. officials meeting in Stockholm in a bid to diffuse trade tensions between the world's two largest economies. I want to go there now. The tariff truce between the U.S. and China expected to be extended by another 90 days. Will that make a difference? Let's bring in a true expert. Diana Choyleva, chief economist over at Enodo Economics, joins the program this morning. Diana, let me put that question to you. Will an extra 90 days make a difference?
Yes, it would actually. A few months ago, when Trump started racking up the tariffs and China responded in kind, it looked like we had the two sides engaging in a spiral of confrontation. And both have walked back from that line. And we are now on the cusp of what I call a graceful decline deal. I'm not sure graceful is the right term really to describe President Trump's administration, but the idea here is that we are highly likely to see a kind of a detente deal emerging at the end of the next 90-day extension. And there are a lot of details to hammer out, so that extension will provide the time for the two sides to get going on that front.
When it comes to getting going, though, I mean, walk us through the sticking points, because it feels like actually making progress on so many issues when it comes to technology, rare earths, energy, the geopolitics, even IP, we're still a far cry from any sort of actually concrete agreement. Diana, what kind of progress can we expect from the talks today?
Look, I mean, if you take a step back, trade negotiations can take years to actually hammer out a proper deal. I'm not talking about that type of deal. A grand bargain, a deal that addresses each point in the confrontation between China and the U.S. is highly unlikely. Highly unlikely. What I'm trying to describe by this detente type of deal is a deal that allows markets months of respite. And we will be back to confrontation, I would argue, within next year at some point. So whatever agreement is reached at this point, it will be just an interim pause. You've seen that all of the agreements that the U.S. is reaching with other allies really also have the goal of encircling and isolating China. So China is crystal clear about America's intention. America is crystal clear about China's intentions, though there is a lot of misunderstanding between the two. But I think that fundamental clash is there, and that is unresolvable. It is unresolvable for a variety of reasons, but not least because both countries are vying to be for the technology leader of the future.
Diana, there's a question here that whereas European leaders, arguably the UK, other countries around the world are keen to get this a trade deal, regardless of what it is, done quickly to lock in some sort of rate, China is willing to play ball because they have an arsenal of cash, resources, people at their disposal, not to mention a far-reaching reach, I should say, into the rest of the world. How prepared are they for a sustained trade war?
They're well prepared. They spent 10 years preparing, and actually they're the stronger side in this kind of round of negotiations for a variety of reasons. First of all, they have much longer political leeway, and with the U.S. Kind of perceived as the aggressor here, they can justify more pain to their population, whereas Trump will have to be much more responsive to his domestic political situation. Another critical difference is that China has found kind of surgical economic tools, such as the critical mineral bans, that can inflict almost immediate pain. And such tools America doesn't have. It has ones that will lead to serious escalation. For example, if America decides to stop China's access to the US dollar financial system, for example, that will be a massive escalation. So China has smelled blood in the water, if you'd like, and is pushing. And we've seen the US caving on the export controls, which is really where China is focused on. Of course, the overall level of tariffs is very important because if they end up with tariffs below 20%, let's say, on top of the already existing Trump term tariffs, then China will probably be able to deal with those, and they wouldn't be a sort of a fundamental hit to its export sector. But anything above 25% will be a serious difficulty for China. And so we have the tariffs on the one side, but really what China is most concerned with is this technological containment in terms of the export restrictions related to technology. And we've seen the U.S. already give ground on a few of those restrictions. So the question is how much more? And while the U.S. is doing that tactical retreat, if you'd like, what comes next afterwards? That's why this is a graceful decline deal and not a grand bargain.
Well put. Diana Choyleva, chief economist over at Enodo Economics, walking us through the dynamics between the world's two largest economies and, of course, what we can expect later today in those discussions in Stockholm. For me, the big question remains, one, how much pain is going to be ultimately borne by the consumers, the global consumers, and two, what the framework looks like for the likes of China. We've got the perfect person to talk about this, Bloomberg's trade czar, Brendan Murray, who, of course, follows these trade deals around the world and the nitty-gritty, joins me around the table. Brendan, I want to ask you the latter question first. We have a framework deal with the U.K. We have this 15% now with the EU, even 15% with Japan. Does that framework or even does that number apply in any way to what we might get from China?
Yeah, I think they're all interconnected in some way. Bloomberg Economics has estimated that we are now looking at an average U.S. tariff rate of 16%. It was 2% before Donald Trump was inaugurated for a second time. So that kind of elevated level is going to put pressure on companies. We were hearing it from European companies already this morning that they're not happy about this 15% that Brussels has agreed to. And something's got to give. It's going to be their margins. It's going to be that they're going to have to raise prices to deal with this. And this is a wall going up around the U.S. economy that's going to make it 15% more expensive to do business there. And that's going to be an economic headwind. The China talks that are going on starting today and into tomorrow in Stockholm are going to address some of these similar issues. Access to critical minerals and critical technologies from the U.S.'s side. So this is all part of the bigger global trade war, the various battles that are being fought. But the ultimate economic impact of it is higher costs, more supply chain bureaucracy, and just a basic pain in the neck for businesses to try to sort out the various country tariffs, the various commodity tariffs, copper's coming on soon. So it just all adds up to a very more difficult world economy to do business in.
There's one person, let me phrase that, there's one country in the world that seems to be having it a little bit easier on the trade front with the United States than everyone else. In my view, that's the UK, with only 10%, several carve-outs involved in that. Yes, we only have a framework at the moment, but still that deal looks softer than what's being offered to the Swiss, the EU, Japan, certainly China, among others. What is the UK doing right here? What are they offering that is sweeter to the White House?
Well, I think there's a bit of Donald Trump involved in this. He's made no secret about the fact that there's the special relationship that he's maintained. He's got the state visit with the royal family coming up, and he's got this. And the UK were first in line. They were quick to move. And it was said all along that you're going to get a better deal if you move quickly. So I think that there's a natural affinity there between President Trump and the UK. His businesses, obviously, he's got a couple of golf courses in Scotland, but there seems to be some sense that the UK is getting a better deal than these others. But of course, the steel issue here in the UK is something that's they're still dealing with a 50% tariff, and some of those details may not even be worked out by the two sides in his visit here this week.
Yeah, Ursula von der Leyen floating that when it comes to steel and aluminum, maybe the quota system may be put back in place. Still waiting on those details, of course. Bloomberg's trade czar, Brendan Murray, walking us through those dynamics of the various negotiations between the United States and the rest of the world. I want to stick with the UK, though, because although he's talking about similarities between the United States and the UK, there is one key difference and one key sticking point. The UK Prime Minister Keir Starmer due to meet Donald Trump later as the two sides seek to tie up, of course, the details of their trade deal, as we just discussed, but also discussing a ceasefire in Gaza as pressure grows on Israel over the rising number of people starving there. Israel says it has resumed limited deliveries of aid to Gaza. Let's get more from Bloomberg's Horizons Middle East and Africa anchor Jumana Bersetchi in Dubai. Jumana, this has become a real sticking point after France, Canada as well are expected to raise the issue of Palestine becoming a state nation in the upcoming UN summit. Keir Starmer facing a lot of pressure. What can we expect on that front in his conversation with Donald Trump today?
Exactly as you say, there's a lot of pressure building on the UK Prime Minister Keir Starmer to recognize Palestinian statehood, but that is not on the agenda for today. He will be meeting with President Trump to discuss trade and, of course, amongst other things, the situation in Gaza. A Downing Street spokesperson has said that they will try to push to revive those ceasefire talks that fell apart towards the end of last week. You will recall that both American and Israeli negotiators left those Doha discussions last week with the U.S. envoy to the region, Steve Witkoff, saying that Hamas had not been cooperative or serious about the discussions. But the other topic on the agenda today is the very stark humanitarian situation in Gaza. That same Downing Street person saying that they will speak about the, quote, unspeakable suffering and starvation in Gaza, with many people around the world shocked at the images of those starving babies and children from last week. And to that effect, over the course of the weekend, Israel has lightened or alleviated some of the curbs to get the passage of humanitarian aid into the enclave. They've now allowed for the passage of around 100 corridors, 100 trucks by land through these humanitarian corridors. These are to be administered by the UN. Airdrops have also resumed over the course of the last 24 hours, both by Israel but also by Jordan and the UAE as well, though many international aid agencies say that these airdrops themselves are unlikely to be very efficient because the actual aid that is being dropped is unlikely to end up in the hands of the people who need it the most. That being said, the situation has been improved somewhat, but again, these same aid agencies are saying that this is a buildup of weeks of starvation, and this is a patchwork solution rather than a long-term solution. Now, Israel, the Prime Minister Netanyahu has said that there is no starvation in Gaza, and what has happened is that Hamas have been stealing the aid. He is also under pressure from within his own coalition to not restart and reopen those humanitarian aid corridors because those on the far right would like to have had a discussion beforehand. So there is pressure both from the international community to reopen those corridors, but also within his own coalition to hold back.
Bloomberg's Jumana Bersetchi reporting for us in terms of the pressure that Keir Starmer and other world leaders are facing when it comes to the humanitarian crisis in Gaza. We thank you so much. I want to stick with another flashpoint around the world that's catching a lot of attention. The leaders of Thailand and Cambodia meeting today in Malaysia for emergency peace talks after President Trump threatened to withhold trade deals unless both sides cease their hostilities. Now, a border conflict that broke out last week has become Southeast Asia's deadliest in a decade. More than 30 people have been killed and 150,000 have been displaced. We're going to continue to monitor those conversations, bring it to you right here live on Bloomberg Television. Coming up on the program, we're going to switch to the corporate sector. We're going to talk about earnings. Heineken net revenue, for example, for the first half year meets estimates, but beer volumes are down. We're going to work on the details next. Stick with us. This is Bloomberg.
I would say, as just like a single organization or single person, you really cannot go that fast for a long time. Okay, you collapse. Okay, like I can work in like for 3 days and without any sleep, but but not anymore. Okay, not anymore. And you really cannot like work 30 days and don't have any sleep. Okay, no way you can do that. Okay.
Work ethic in China is famous.
But I would say collectively, we can have a very fast iteration. Okay, so that's why I really like a stubborn mindset. So basically, like DeepSeek could do something very fast. Okay, and then we also have Queen. Okay. And then we have Kimi, okay. So collectively, and we can push that fast. I think that's okay. Actually, that's what I think it's important. Otherwise, why we need that population, okay? So that's why when people get together, and it's not just for competition whether you win or not. It's basically you can have the very fast iteration of the technology because of this competition, or because and you work fast this time and you slow a bit, and then other guy move very fast, and eventually we slow down a bit. And if you're good enough, you can catch it again. And I don't think it's brutal, but I think it's very healthy because, and when we work with the people that is very competitive, that would make you much more competitive, because that was the way how I think the new technology will be invented.
Yeah, you're talking, I guess, about more of a marathon, not just a sprint race.
Yes.
Is there space, though, for new contestants to enter that race today?
I would say, at least for AI, it's a marathon, because I think nobody could really see, if it's a long journey. It's definitely in the very beginning.
Alibaba Cloud founder Wang Jian speaking exclusively to Bloomberg Television. Let's go from AI to airplanes. Boeing preparing for a strike at its St. Louis defense hub after workers rejected an offer that would have boosted wages by 20% over 4 years. Now, the union, which represents more than 3,000 Boeing defense staff in Missouri and Illinois, said members voted overwhelmingly against the new terms on Sunday. Any labor strife would be costly for Boeing's defense division, which hasn't made an annual profit since 2022. Now, this is a brutal transition, but from planes to beer. Naturally, Heineken is one of the biggest fallers on the Stock 600 after reporting a decline in beer volumes. It says retailer disputes across Europe dragged on sales and limited its ability to take advantage of the summer heat wave. The CEO told us that the company had been planning ahead for U.S. tariffs.
This is something that we can absorb and will absorb and is explicitly implied to our profit outlook for the rest of the year. Beer is a very capital-intensive business. When you build a brewery, it's going to be there for decades. So any decision to move manufacturing would be a big decision with long-term ramifications. And for us, predictability, consistency in outlook is very important.
Bloomberg's Saba Meddings joins us now, covers the company, of course. Now, we know that they are a little less exposed to the tariff story relative to perhaps other European corporates. But the tariff story impacts consumer confidence and impacts business confidence. What did he have to say about that?
Well, he talked, there's sort of 2 points to that. One is the kind of the U.S. consumer. He talked about a lot, sort of saying that, he's the decline in the pace of consumer spending is something he's not seen before. So there's kind of that part of it. If you've got tariffs, 15% tariffs, although they have kind of baked it in, what does that mean for prices? For a consumer that's already feeling constrained, already sort of not spending, that cost has got to go somewhere. Either it's going to come out of Heineken profits, or it's going to be pushed through in consumer prices. So that is going to be something we're going to have to watch.
What else do we watch? I believe they have a conference call later in the day as well. Are we getting a little bit more insight in terms of perhaps the retailer pricing issues that they've had in this region?
Yeah, the results were interesting today because obviously the dispute with the retailers went on for much longer. It's more of a protracted negotiation than initially hoped. And what we have seen is early signs that France, now that's been resolved, sort of consumer confidence has increased. So investors will be looking out for any sign that other markets where they have resolved these disputes, what are consumers doing now? Are they spending? Can Heineken sort of cash in the rest of the summer? We have been having very warm weather. There has been lots of sport. Can they sort of cash in on that now that they've resolved and sort of got back on that shelf space in their other markets?
So what are people drinking? If they're not drinking beer, what are they drinking?
Perhaps it's a summer of cocktails. Volumes, they're not huge declines.
Right.
People are still out drinking beer. If you look at the UK as well, Heineken performed really well on the on-trade in pubs. The Heineken 0.0 is doing well. So, this is not a kind of no longer drinking beer story, but yeah. It could be other things too.
If there's one thing you can count on in this uncertain world, it's Brits drinking at a pub. Bloomberg's Sabametic walking us through the Heineken story. Those shares, of course, down this morning amid a sea of green. We thank you so much. Let's broaden this out, though, because it is a big week for European corporate earnings results across sectors, from banks to pharmaceuticals to autos. 3 places where maybe you want to look for that tariff read-through. Earnings, of course, expected to show that uncertainty and tariff-fueled cost increases. Tim Craighead, our Global Chief Content Officer and Research Director at Bloomberg Intelligence, has been combing through the details. We're waiting for this to show up. We're waiting for margin pressure to show up. We're waiting for buybacks to stop and for bracing for some sort of impact. We haven't seen it yet. It's been 3 months. Do we see it this week?
Yes and no. So the yes is companies are going to comment on it, and we can talk about that. The no is it is largely too early to see these things coming through. That'll be a third quarter, a fourth quarter, and a 2026 real impact. But what we have heard and seen, and there's a great note from our European equity strategist on the system this morning, is that companies are talking quite actively about 4 different categories of impact from tariffs. One is trade disruption, think sales impact, cost impact, supply chain impact, or customer uncertainty and lack of confidence in moving forward. Those are negatives. That's roughly half of the companies that we noted. There's another large group that are seeing some elements of mitigation or some elements of price pass-through. But largely, it's, unsurprisingly, a negative.
In terms of that margin pressure, though, I'm curious how it may not show up in the likes of autos and pharmaceuticals. The 15% tariff rate, slightly higher than what the market was expecting, but still perhaps not as high as the 70% or even the 25% or the 30%, all the numbers that were thrown out there. How does this affect those 2 specific sectors?
Yeah, it's interesting. On autos, as you said, 15 is better than 30 or 27.5 or whatever the number might be. But a 15% tax is a 15% tax, and somebody is going to pay it. That will have an impact and will have a bite. It's a question of how much of that was already embedded in earnings estimates. And, European auto companies are under multiple threats. One's tariff. Another is the EV transition taking longer. Another is China coming in and being more competitive itself, as well as having a weak market for sales there. So you look at BMW, look at Porsche this week, we're going to hear about all of those factors, much less Europe having a strong currency right now versus the dollar. And so there's multiple points of reference beyond just simply trade. The same is somewhat similar with the pharma. At least that seems to be settled. And now maybe we get back to looking at actual pipeline developments. So somebody like AstraZeneca that reports this week, it arguably has one of the best growth profiles if it can execute on the pipeline.
All right. Tim Craighead from Bloomberg Intelligence. He's going to be, of course, back throughout the rest of the week as we monitor these earnings. We thank you so much. I will leave you with one stock that you probably want to keep an eye on as we head into the U.S. pre-market trade and into the U.S. opening bell. Tesla shares higher by about 2%. This comes after Samsung is due to produce AI semiconductors for Tesla. And get this, a $16.5 billion pact. In a post on X, Tesla CEO Elon Musk saying the plan is for an upcoming plant in Texas to produce Tesla's next generation AI6 chip. Those shares higher by about 2%. Stick with us. Bloomberg Brief is up next. This is Bloomberg.